What's up, everybody? It's Austin. It's Wednesday. Inflation came out lower than what was feared, and the market is just going wild. This is just a reminder. Let's keep our minds about us and not get reckless and crazy. It's easy to get reckless and crazy when things start going good. Even when times are bad, stick to your investing plan. When times are good, stick to your investing plan. It's important both times, but it's almost more important to reinforce good behaviors when times are good, because that's when it's easiest to get overexcited and do crazy things. We're talking about the return of FANG, maybe. Is FANG back? Big cap tech is doing really good. We're going to talk about some of that. I'm obviously going to share my portfolio and share an update. It's crazy how much the portfolio has recovered, and I've shared this before. I actually prefer the portfolio to stay down because I'm adding money every 2 weeks, and I want to buy more shares lower. All right, the goal is basically no edits because nobody's got time for edits. Let me know in the comments if you like this video format. Let me know how your portfolio is doing and if you have any other companies you want me to review. So here's the portfolio, 10K to 1 million. The goal is to grow this thing to $1 million in 10 years. Long-term investing is what we do here on this channel, and I share every step of the way. $96,190. We're about 10% of the way there, which sounds like we still got a long way to go, and we do, but with compounding and the way that works, it can actually come quicker than you would imagine. So we're up now $9,258, which is showing a 20% return. Over the last week, we're up $8,000. On the day, we're up $7,000 today alone. How crazy is that to be up $7,000 on the day? Here's the portfolio. I have a newsletter, austin.substack.com, linked below, where I go in depth and provide a deeper level of research and buy alerts before I buy anything. But I just want to show you, I own Meta, but I don't own Apple, I don't own Google, I don't own the rest of the FANG stocks. Okay, so those are the ones we're talking about today. And this is what I'm talking about. Over the last month, Apple's up 15%. Over the last 6 months, they're still down 2%. Year to date, they're down 7%. But look at that recovery, up 15% over the last month. Let's take a look at Meta. Over the last month, up 9%, still down pretty big year to date. Let's look at Microsoft, up 11% over the last month. Let's look at the GOOG, only up 3% over the last month. Interesting. It also hasn't been hit quite as bad as some of those other ones year to date. Let's see how Netflix is doing. Still down 60% year to date, up 35% in the last month, Netflix is. Okay. All right, so what I want to do now is I want to talk about, are these stocks good buys right now? Is Apple a good buy right now? And the way I want to look at this is compared to how it's been valued historically, right? And so that's what this chart shows right here. And so we could see that over the last 19 years, so this black line is the current stock price. It's got a blended PE of 27. This orange line is the PE times its earnings growth rate, which would be 28. That's how much earnings have grown on average over the last 19 years. But we've got a comment on that. The average PE ratio has been 21. So if you look at this, it looks like Apple is just extremely overvalued compared to its normalized price to earnings ratio over the last 19 years. Because generally it's traded at a PE of 21. It's trading at a PE of 28 right now. And so, or a PE of 27 right now. So we can see how Apple lines up with its historical precedent. But let's go back less years and get it to where Apple's a closer to the size that it is now and closer to the growth rate. So if we go back to 2015, their earnings growth rate has been 13%, and their normal PE ratio has been 18. And so now if we look at a PE of 27, it's way above the normalized PE ratio, making Apple look very expensive. And then if we look at the PE growth expected moving forward, 9%, 6%, and 8%, that makes it seem even more overvalued. And so for me right now, Apple is not a stock that I'm interested in, even though it's a fantastic company and will probably do just fine. I just don't see the upside there, especially the size of the company, compared to other options that I have. But I know a lot of people do. A lot of income investors like Apple, or a lot of dividend growth investors like Apple. All right, so Meta. I do own Meta, and I talked about that. Meta's kind of a different story. It's trading almost cheaper than it ever has before. So again, if we're looking back to 2011, The average PE ratio has been 35. Average earnings growth rate has been 28. And right now it's down to 14. So a significantly undervalued compared to where it's traded historically. But Meta's growth also isn't the same as it previously was. So if we move back to 2016, we see the normalized price earnings ratio has been 26. So that brings it down a little bit, but still it trades at a significant undervalue to what it has traditionally traded at. But they grew earnings a lot faster previously than they're expected to in the future. Okay, so what I've done is I've gone to forecast. Down here, you can see the forecasted earnings estimates by analysts. So we've got 48 analysts with their estimates in for 2023, 47 in for 2022, 27 for 2024, and then I just put in 10% earnings growth for 25, 26, and 27. This can give us an idea of if this stock is undervalued over the long term, given its expected earnings growth rate. So analysts are expecting negative earnings growth this year. We've already seen that in the results. And again, we are looking at a current blended PE of 14, which is pretty much lower than it's ever traded at before. So my baseline is to stay around 14. So I'm going to go out to say 2025 and look at a PE ratio, a blended PE of 15, which is pretty much staying constant with what it's at now. That gets us an annualized return of 8% or a 30% total return. If we go out a couple more years, then we're looking at, to 2027, we're looking at a 9% annualized rate of return. So that's kind of my baseline expectation for Meta, and that's why I own the stock, is that's kind of my baseline. But if things get a little better, and maybe they get up to a PE of 18, then we're looking at a 12% annualized return. And remember how high Apple's PE was, right? And we don't expect that with Meta, but a PE of 21, if they get earnings growth back and revenue growth back, and if the metaverse starts to work out, it's not out of the realm of possibility. Then we're looking at an annualized rate of return of 16%. The other variable here could be that their results are better than analysts expect and things start to turn around in advertising and the metaverse starts to work out. That could make all these numbers go higher and it could make the returns go higher. That is why I personally own Meta. Or they could miss horribly and everything could go bad and the stock could just crater. Okay, last one we're going to look at is Amazon. I don't own Amazon right now, but I have previously. We've got to look at Amazon based on price to operating cash flow, and it does look pretty significantly undervalued compared to historical price to operating cash flow. It's trading at about 25 right now, and normally it trades at 27, but the growth is supposed to be pretty significant over the next couple of years. And so again, let's just look at since 2014, it's had a price to operating cash flow of about 26. It's currently at 25, so in line, right? But they're expected to grow operating cash flow 36%, 51%, and 32%. And so Amazon, if they just get back to that normalized price to operating cash flow of 26 or stay around that, then the annualized rate of return is going to be 43% over through 2024 for 136% return. That would be pretty incredible, and it's not guaranteed, obviously, but it's also not out of the realm of possibility when you look at how discounted Amazon is. So if anything, my note for myself is consider Amazon kind of strongly again, although I'm pretty happy with the portfolio that I have right now. We'll see. But I'm not as interested in Apple, even though it's a very premium name. It's just, it trades like it is. It has a very high PE. So jumping over to Morningstar, they give ratings to all kinds of stocks. They have Apple at a 2-star rating, and that's because they have it overvalued, which kind of like I was just talking about based on their valuation. And again, Morningstar is pretty conservative, but they have the fair value at 130, and Apple's currently trading at 164. They have a narrow economic moat, which I think is ridiculous. It's hard to find a company with as much of a moat as Apple, but exemplary capital allocation, which I agree with. So anyways, that's Morningstar thought on Apple. They've got Meta at 5 stars. And again, Morningstar is a conservative. They look at things pretty conservatively. And so the fact that Meta is trading below its historical average is why it's showing this. But if this company's broken and the results don't pan out, then so no matter how cheap a stock gets, if the company's not going to do well, I would not want to buy it. But I happen to think that Meta's business is healthy and they are going to do well in the future, which is why I own it. Anyways, based on valuation, Morningstar has them at a 51% discount to fair value of 346 with the last closing price at 168. They give them a wide economic moat and exemplary capital allocation. I don't understand why they wouldn't give Apple a wide moat. It just doesn't make sense to me. So that's their thoughts on Meta. And finally, Amazon gets 4 stars as well. They have it at a 28% discount. The fair value they have at 192, and the last close was 137. So they get a wide economic moat and exemplary capital allocation as well. I own Meta. I'm going to keep owning it, and I am going to do a little bit of a deeper look into Amazon. So like the video, subscribe to the channel if you want to get these updates. Hit the notification bell so you never miss a video.